8. Let's read the ask first. Using the drag and drop options below, demonstrate how this company would account for this $1.5 million adjustment in its financial statements as at 31st March 11. How they are going to account for this transaction. Mhm. Okay, what is the transaction then? On 1st April 10, this company acquired 75% of another company's equity shares. Okay. And an additional amount payable that was contingent upon the post acquisition performance. Okay. So they acquired 75%. So they are giving their shares, and there is an amount payable also that will be paid on 1st April 11, like the first day of the next year. But that amount is contingent upon post acquisition performance. Okay. So at the date of acquisition, the company assesses that the fair value of the amount they are going to pay, the contingent liability or the contingent consideration, is 4.2 million. But by the end of the year, on the last day of the year, 31st March 11, now they believe that they will be paying 2.7 million only. So initial their estimate was 4.2 million, 4.2 million. Now they are saying we will be paying 2.7 million only. So now their estimate has reduced. So they are saying that now we will be paying 1.5 million less. Okay. 4.2 minus 2.7. Okay, this amount is given also in this question, so we don't need to calculate. They are just asking the journal entry. So because their liability is reduced, they will uh, their liability has reduced, so they will debit current liability. Okay. And they will credit what? They will credit the retained earnings. Okay. There is no effect on retained earning, sorry, goodwill, because this transaction is after the acquisition. This leads to the post acquisition period, so no question of goodwill there. So they will debit their current liability because they are reducing it, and then they will credit their retained earning because the expense side is also being reduced.